Welcome to Stock Talk with Mike. So I think it's been over a month or so since I posted my last video. The spring is just a really busy time for me with my day job, but also I think I was just starting to feel a lot of stress about what stocks I was going to talk about next and if they'd get views or not as I'm trying to grow my channel. And videos like the one I want to post today, a bit of a portfolio update and about how I manage investments in my portfolio, don't always get the most number of views, but I want to bring you this kind of content moving forward and bring you content that I think is of value and not so much focus on how particular videos might perform. And I'm actually really excited. My wife and I just refinanced a rental property, and we're looking to use the cash proceeds from that refinance to hopefully double the amount of money we have invested in the market over the next year or so. So definitely don't want to put it in all at once, but I want to look for opportunities if we see any pullbacks in some of our highest conviction holdings, looking to add to those, but also maybe starting new positions in any companies that I currently have on my watch list as well. So today I want to talk to you a little bit though about where my portfolio's at. I've definitely added to a number of positions over the last month. Also, probably started a few new positions in there as well. So just show you a breakdown of my entire portfolio. So let's get right into it. One thing I like to do is actually take all my holdings in my brokerage account and plug them into Yahoo Finance. It just, I don't have the ability in my brokerage account to break my holdings down into these type of folders that I like to do. And I like to put companies and put a label behind them in terms of the type of investment, because I actually manage them all a little bit differently. And it helps me mentally remember how I classify my investment and how I'm going to trade around that position or treat any sell-offs and that sort of thing. So definitely the largest part of our portfolio is our growth portfolio. So these are high growth stocks, generally like 40% annual revenue growth or more a lot of times. Disruptive, innovative companies that I think are going to be much, much larger 5-10 years from now. And generally these are very long-term investments that I plan to hold forever unless the thesis really changes behind that investment. So maybe the reason I bought it in the first place isn't valid anymore, or major competition comes down, or the company just isn't executing, is maybe losing market share or has declining revenues. But for the most part, I'm going to hold on to these stocks for the long term. And I'm definitely going to track them very, very closely as far as watch or listening to conference calls of any quarterly earnings reports and keep up to date on any news relevant to the company. And also same with the staples portfolio. These are more blue chip type companies or stocks that also maybe trade at a little better as far as valuation in terms of PE ratios or price to sales ratio, that sort of thing as well. And possibly a dividend, although I'm not really too focused on dividend investing. These are also long-term holds generally for me. And I would actually like to see the staples or value portfolio portion of my portfolio get a little larger. I'm definitely underexposed to financials right now, or at least as far as like banks go. Definitely fintech I'm invested in, so that's an area I could see adding to, but they've been on quite the run rate lately, so I don't see myself adding at these levels. And then spec portfolios, some more speculative stocks. These are very small market cap companies, definitely companies generally that aren't profitable or have very little revenues that could pay off big if they execute their business plan. And generally these are smaller holdings, and often when these sell off hard, I don't necessarily add to these positions unless maybe I think there's like a real valid reason for it. These are highly volatile stocks, and I keep it a relatively small portion of my portfolio. And then I have a small amount of money also invested in crypto, basically just Bitcoin, a little bit of Ethereum as well. And then trades. I think this is really important for me. Is I like to identify if I'm making a trade. This is generally very short term, where I think maybe a company is trading below its fundamentals or below its fair value. and I think has 20 to 40% upside in the next 3 to 6 months or less. I like to see these trades play out definitely in less than 6 months. I give them a decent amount of time. I expect them to play out in around by 3 months, but within 6 months, I expect to hit my targets. And I keep these on a very short leash. I'm definitely not adding to trades if they sell off, and I never turn them into investment. So maybe the trade doesn't go my way. I expect it to increase in value and it sells off. I'm not like, well, I'll just wait and see how it pans out. I would actually cut my losses on these positions. So by classifying and putting in that trades portfolio in that folder, I remember how to treat that investment, and I'm going to be cutting any losses and looking for that upside in the short term, and then rigging the register on those profits. With my growth portfolio and staples, I'm not really ringing the register on 20% or 40% gains. I might trim a little of those positions if we see 100, 200, or 3x type returns. I might trim a little just to keep it properly weighted in my portfolio, but I'm definitely not ringing the register on something small as a 20% gain in my growth portfolio. I'm looking for much bigger gains than that in those holdings over the long term. All right, so let's have a look at my growth portfolio. So Airbnb is actually currently the largest position in my growth portfolio, which is a little surprising to me even, but I started a position, I think, not too long ago, and then we saw a bit of a sell-off into the 130s level, and I started aggressively buying more, as I am sitting on a lot of cash right now, as I mentioned, and this is just one of the ones that I was able to build up that position size on quite quickly as of late, and then it's actually increased in value the last month or so and been doing much better, and it currently finds itself as our largest position, our growth portfolio. Next is Square, which I actually am a huge believer in Square. I really like what Jack Dorsey and Square are doing. They're extremely disruptive, and they're just moving into a lot of potential big revenue streams moving forward. People act like they're just a crypto play, and that's so far from the truth. As far as they're actually carrying the balance sheet in Bitcoin, that's really not going to move the needle as far as the success of Square, in my opinion. Even if we see 50 or more % retracement in the value of Bitcoin, that's not really going to affect Square. Of course, they benefit from people transacting, buying, and selling Bitcoin through their Cash App, but they're going to find that benefit whether it appreciates in value or declines in value. As long as there's a lot of volatility, as long as there's a lot of volume and people are buying and trading cryptocurrencies, Square, I think, is going to be a big benefactor there. But I honestly think the cryptocurrency Bitcoin component is a relatively small part of Square's business. They're a huge play on small business with their chip readers or small business ecosystems, and they're just really firing on all cylinders. Taking market share, growing at an incredible rate, and definitely taking market share from PayPal with their with Square's Cash App as well versus Venmo. Next is Invitae. Invitae is just an absolute beast. This is the play, I think, in artificial intelligence as well, which a lot of people don't talk about. Just growing incredibly well, trades at a reasonable valuation even as well for a high growth company. I think growing at about a 40% annual revenue growth rate as of late. And I've owned this since I think around the 140s range or so. And I actually added some as I had a little bit of dip before the earnings report, I think around 495 or so earlier this year when we had that big tech sell off. And yeah, it's been doing really well as of late. They just reported earnings, absolutely killed it. And I see definitely Invitae as a long-term investment. Happy it's one of the larger positions in my portfolio. Next is Unity Software. So they're the 3D engine for game developers, but they also, outside of gaming, they're involved in developing 3D components for all kinds of other industry now as well. And I think that's a leg of growth that analysts and investors maybe don't think about a lot with Unity. And I see a lot of opportunity there, growing at about 40% annual revenue growth rate there as well. Hasn't performed super well as late, but I've been adding to my position at Unity. It represents a fairly large position in my portfolio as well. Next is C Limited. Trades at quite the valuation. This is the at a high valuation, but again, a really high revenue growth rate company. C Limited is an e-commerce leader in Singapore. And again, just performing incredibly well, does trade at a premium, but I think it warrants that high valuation. Not looking to necessarily add more at these levels with C Limited, given it does trade at a premium. But if I saw a significant pullback, this is one I would continue to add to as well. Teladoc Health, TDoc. This is an interesting one. It gets lumped in the COVID plays, and also the high-flying growth stocks that are just getting slaughtered, or high valuation, high growth stocks that have been slaughtered in 2021, but are seeing a bit of a comeback as of late. But Teladoc was growing incredibly fast, I think around 100% revenue growth rate pre-COVID. And it's done incredibly well during COVID. And it's still, like, with these kind of growth rates, I think right now is trading at about 15 times sales, which when you compare it to some of these SaaS, cloud software type companies trading at 50 times sales or more, Teladoc is actually not that expensive. I think one area of concern is competition in the telehealth space. But honestly, I think telehealth definitely outside of COVID is something I think is going to only continue to grow. I don't think it's a COVID play, but they're by far also the leader in this field. No one else even comes close. I realize Amazon and other big players are also entering the space, and we need to watch the competition, but no one is as big in telehealth or virtual doctors as Teladoc, or gaining market share as fast as Teladoc. So even though they're the biggest, they're also growing the best or the fastest. So that's the kind of company I want to be invested in. I don't want the second-rate one because it's a smaller company. Doesn't necessarily it's going to perform better. That's not generally the way I have found that investing pays off in the long run. Next is Palantir. I think big data and big data analytics is only going to get more complex and more market for. And I really believe in Palantir for the long run. Again, it's another top 10 holding in the growth portfolio here. And yeah, it's another one I plan to hold for, obviously for long term. As with that goes without saying for all of these. It doesn't need to be said. These are all long-term investments for me. Next is Pinterest. It's definitely my favorite of the social media stocks. A relatively new position for me as well that I've been building out here, and taking advantage of the growth stock sell-off to build a fairly decent-sized position here in Pinterest here in 2021. Next is Tattooed Chef, a position size that I don't think I'd probably make any bigger at this time. I'm pretty happy with the position size here. This was for some additional exposure to the consumer goods space, where definitely I don't have a lot of exposure to. It's kind of that early innings, I think, for Tattooed Chef, where they're expanding into new stores and different outlets, and I think in that way they have a lot of runway and growth ahead of them. But I think as this company, as it matures over the next several years into a typical consumer good company, like compared to like a Campbell's Soup or something like that, I would look to trade out of my position at Tattooed Chef at that time. But I want to be part of it in the early stages of its growth trajectory here. Next is Crowdstrike. So the endpoint cloud-based cybersecurity company that is growing again like a absolute weed, like 70-80% annual revenue growth this year. And I think this is just an industry, cybersecurity, that you gotta have exposure to. It just makes so much sense on so many levels. And Crowdstrike, I think, is the leader in that space. Definitely trades at a premium valuation, but I definitely think this can be a high margin business that they can grow into that valuation over time as they continue to take market share. They just have so many big Fortune 500 type companies as partners of theirs and customers of theirs, just executing an extremely high level. I think Crowdstrike is a phenomenal company. Next is Shopify, relatively new position for me. I've been building out. I'm still building out. I'd like to see a bigger position here. I'm really big on the e-commerce trend as well. So I have a lot of investments in e-commerce, and Shopify is helping provide e-commerce for small business. which obviously have benefited during COVID as a lot of small businesses moved their business online. And I think that is something that's going to stick around as companies realize that they can get better margins and better profits for moving their business online. So yeah, Shopify, again, just a really high flying growth company, trades at a rich premium valuation. But I think it's one of those companies still has a lot of growth ahead of it, and I could see it being much larger. It's not small now, but I could still see it being much larger 5, 10 more years from now. Next is Coupang, and it's actually another e-commerce play. This one's out of South Korea, definitely the leader there. And they're really they actually, as far as their e-commerce side of things, very, very comparable to Amazon without the AWS, I'd say. But Coupang is a very interesting company. Definitely, South Korea is actually a pretty progressive market as far as e-commerce. And yeah, a very interesting company. And just kind of building out my position in Coupang as well. And I think I'll be posting more about this company and tracking it very closely over the next few years. Next is Enphase Energy. So this is my green energy solar play. I definitely Enphase is my favorite solar company. Trades at a moderate okay valuation, a little on the high side, but it is profitable. They do have earnings, and I would like to build out this position a little larger. If we could see much of a sell-off here in Enphase, I'd be looking to add to this position. Next is Redfin. So disrupting real estate by providing low fee, low commission real estate transactions. I think real estate is an industry just prime for disruption. It's been the same for decades, and Redfin's been a really good investment. I've actually trimmed a lot of profits in Redfin. I'm not 100% sure how the housing market's gonna play out and how Redfin's gonna fare in the long run. And I would say it's not my highest conviction growth stock, but I've maintained a position. It just flew up so fast from 20s all the way up to like 80s that I was trimming. But here in the 50s, I think it's fairly attractive. And if it dipped back down much lower, I'd maybe be looking to add back at a much lower cost basis than some of the profits I took at much higher prices. Next is Canopy Growth. So this is the MJ play. That's my only real exposure to that space. It's probably the biggest player in the space, and I like their partnership with Constellation Brands, and I just want to have some exposure here while this industry kind of matures and plays out and be a part of that growth. Next is Tesla. So a pretty small position in Tesla. I don't think I'd be looking to necessarily add unless we saw Tesla dip maybe into the 400s or so. I really like a lot of the optionality Tesla has for the future. And this is totally the type of company I like to be invested in. But at the same time, I am concerned a little bit about competition, and definitely in the EV side of things. And, you got Ford coming out with the Ford Lightning truck, and every automaker is jumping on EV. I have some concerns about valuation, and if Tesla ever starts coming in and being re-rated and valued more like a car company, a traditional car company, then you could see much, much lower share prices, even if they continue to grow, even if they take more market share in sales. You look at a company like Ford that trades at under 10 PE versus Tesla, I think it's in the 90s, right? So nearly 10 times as expensive from a valuation perspective. And I think that's for good reason that it's more expensive, given the optionality of Tesla, the innovation, the growth, compared to some of these legacy car manufacturers. But I just worry what that future looks like as they start to mature here and how much big growth they got ahead of them, and if that risk reward's really there. But I like Tesla for the long term, and plan on definitely holding this position. And yeah, I wouldn't mind it being bigger, but to be bigger position for me, I think I'd have to see it at much lower prices. Next is Aerovironment. So they're a drone manufacturer for military, also for the agriculture industry and aerospace. And yeah, I think that's a really interesting play as drones have more and more applications. And this stock has performed quite well for me. It's a pretty small market cap company, and I've owned it for quite a while. Next is DraftKings. I have a very small position in DraftKings, sort of a initial position that I took a while after the SPAC, I think in the 30s. And it's just kind of gone straight up. It's pulled that back a little bit lately, and haven't taken advantage of any of that sell-off. So I'd still like to see a bit lower prices to add to that initial position I took. But I would like to get a bigger position in DraftKings. They are growing incredibly fast. Obviously, they provide the sports betting and also iGaming platforms, and I think this is an area that will continue to grow as more states come on as far as legalization of sports betting. But yes, I really like DraftKings for long term, and hoping I could triple or even quadruple this position size over the next several months if I get the opportunity to. And lastly, a very small position left here in Invitae. They're the DNA analytics company for looking for hereditary diseases and precursors to various cancers and things like hereditary cancers and things like that. So Invitae has done exceptionally well. I think I got in around $5 a share, and it's been as high as 60s or more. And I've taken a lot of profits along the way. And after taking profits, it's actually declined in share price a fair amount lately, that I see holding a relatively small position here right now. And I'm not really sure what to do with it here. This isn't a space that I would say I'm overly knowledgeable in and have really any kind of leg up as far as what companies will be the ultimate winners in the DNA analytics side of things. But I plan on holding this position, and if we saw a really significant sell-off, I could see adding to it, because this position is very minuscule, small, and definitely less than like a 1% weighting in my portfolio right now. So at some point, at a certain level, I think it could be attractive to add to that position, because it's definitely a space I think has a huge future as far as continued growth is DNA analytics. All right, next we have the staples and value portfolio. So first is Amazon, which is actually my largest position overall. Now, it's not really a value play, but I think it's definitely a staple. I don't think it's losing half its market value anytime soon. You could actually definitely put this in the growth portfolio category as well. But just it being such a large company, I think around a 1.6 trillion market cap, I think of it more as like a blue chip staple, safe play with still a lot of growth ahead of it, I think, as it looks to expand out more of the international e-commerce, which is taking a more and more large percentage of their e-commerce now is actually international. And there's still a lot of room for growth as they expand out to India and other countries, especially as we come out of the other side of COVID here as well. Yeah, I really like Amazon. Next is Home Depot, pays a decent dividend, over 2%. It's just been a steady performer over the years, continues to grow. So I have a little chunk in Home Depot. Next is IDEX Laboratories, which they do basically analytics for veterinary clinics for pets. And I think the pet industry is just a good industry to have exposure to, as more and more people get pets and take better care of them as well. And it's been a phenomenal performer as well. Really solid company in IDEX Laboratories. Doesn't trade that cheap either, but just like a steady Eddie growth company. And lastly is Disney. I would like to have a larger position in Disney. They're a bit of a reopen play, I guess, as parks are kind of reopening here, but also on the streaming side of things, growing incredibly fast as well. And I think you're seeing it being a bit of a re-rating in Disney as far as the valuation right now, deserving a little higher premium multiple. And I would like to, at least double or even maybe triple my position size in Disney. Next is my speculative portfolio. So largest position in there is JMIA. Again, these are generally a little bit smaller position sizes here. And JMIA is the e-commerce player out of Africa. Really interesting company. Has a lot of headwinds ahead of it still. It's not perfect by any means. Operationally, they still have some things to figure out. But I think this is one that could really pay off and might be worth holding for 10 or more years and kind of seeing if this plays out the way it could. I think JMIA is a very, very interesting play. Still relatively small as far as a market capitalization perspective, and they're doing a lot of things to move towards profitability and streamline their business. So really interesting play. And then I have a couple other really small positions in my speculative portfolio that I'll talk about in another video, I think. And then my one trade right now that I want to talk about is Alibaba. So I bought in recently a little bit of Alibaba at $211.50. I think it was trading at a forward PE, price to earnings ratio, of just over 15 or 15.5, I believe. And that's just so cheap for a company with this kind of earnings growth and this kind of revenue growth. So I just thought, I know obviously there's a lot of headwinds there. China's kind of cracking down on their big tech companies, but I also find that China news cycle kind of ebb and flows. It rears its head and then it kind of backs off for 5 years or so, and then it rears its head again. And I think you're going to see here that noise kind of disappear, and these businesses will kind of start to do their thing. They'll execute, they'll get some really good earnings report, and that share price is going to creep up as people kind of forget about those negative headlines around China sort of cracking down and stifling any growth in these companies, and the Ant Financial IPO halting, all those kind of things that I don't even think were really baked into the price Alibaba at the time. It's just, it offers really, really interesting risk reward here, I think. Like this, for this kind of growth, it's absurdly cheap, Alibaba, at these levels. So, and if you even look at the analyst ratings, not that necessarily always means a lot, but they all have it, generally, the average price target on it's much higher than current prices for Alibaba. So this is a short-term trade for me. As I said, if it drops down, I won't be adding more necessarily, but I'll be looking to take profits with like 20 to 40% upside. Anyway, that's about all I have for you today. So thank you so much for watching and happy investing.